He said sell Tesla stock at about $240, and then he said buy Tesla stock at about $110. His timing was pretty good. This video is a video you definitely want to watch. Let's see what he says now.
Well, it was a bit of a tumble. And of course, it's the reciprocal or the equal and opposite action from the prior quarter. That gap up on the 26th of January, euphoria, and this is the exact opposite. All I can think of here is like, kind of what's the point of buying into Tesla when you've just had a setback like this? You know that for the past 2 months, people have been purchasing the stock basically between 180 and 210. And now you're sitting here at 165, which is to say, let's say it never goes lower. It's just so difficult to go higher. You've got money that's trapped that would love to come out of the bets that were made. Forget about bets from a year ago or two, but just have recently committed capital, and it's immediately wrong. We've all been in a situation, and usually first loss, best loss, you want to get out. I think Tesla's sort of a dull duck here. The downside risk is to that 146 gap from the January earnings. What's the point of buying into Tesla when you've just had a setback like this?
Oh, that is a good question. And this answer you definitely want to see. This is going to be worth watching, so don't miss out on this one. Here we go.
Monday, the chart master Carter Worth said Tesla shares were about to kick it into high gear.
We are where we were in 16, but we're actually getting down to a low that was seen only one other time in history. How far below trend it has ever been since its IPO. Here is the all data chart. This is literally the lowest point it has ever been. I think you've got a situation of so bad it's good. I want to make the bet that Tesla actually is a time, if you're short, to be covering and to being small speculative longs.
That was from 2019, and he nailed the bottom of Tesla stock back then. It was at about $13 per share. Can you believe that? Now, you would, of course, think he would double down on his position. Just about a week later, he would buy a lot more. Like, buy as much as you can, right? $13 per share.
And take a look. Tesla cruising higher this week, up nearly 15% as investors pile back into the stock. So what does he see in the charts now? Carter Worth over the plasma to break it down. Carter.
Well, to some extent, one could say that sort of the opportunities come and gone.
That was at $13 per share, roughly split adjusted. The opportunity has come and gone. This is how you can have a big brain, nail it in the short term, and completely miss the big picture. And sure, maybe you can even buy lower than that. And buying lower is better than buying higher. But the stock, more than 10x, a lot more than 10x. It is still 10 times higher than where it was back then. I don't see any reason to believe that the opportunity has come and gone. That type of short-term thinking is going to be punished, I believe, with Tesla stock. Sure, maybe you'll make a little bit of money short-term, and maybe short-term you are doing better than a long-term investor, but long-term, short-term investors are going to be exactly in that place where they're looking at the stock right now and like, yeah, at $160-ish where Tesla stock right now is. The opportunity has come and gone. Yep. And then these will be the people in 2030 saying, oh, what was I thinking? Sure, and maybe it went lower at a few times, but overall, you look at the big picture, it's like, oh my God.
To some extent, the opportunity has come and gone. I would say you split the difference. If you traded it well off the low, you take some gains and leave the balance for the prospects of further gains.
This was back from 2019. If you just keep reducing your position and you never let it really run, the moment it goes up a little bit, you cut your gains, you won't be able to experience the compounded returns, and your total gains are not going to be nowhere near as high as they should have been. That is one reason why actively managed funds underperform the market. They cut their winners too quickly. Perfect example here, Cathie Wood nailed Tesla stock. It has been Cathie's favorite position for a long time, yet Ark Invest returned a whopping minus 4.44%. If I show this number to my wife, she is a Taiwanese Canadian, she will think that this fund is cursed because the number 4 in Chinese sounds like the word die. Triple death. I think a lot of things that Kathy says about Tesla do have good insights behind them, but Tesla went up 741% while Ark Invest is down during that same period. It is because you cut your winners.
I know that you are an avid watcher of the show in general, Carter, so I'm wondering what you think of Dan Nathan's price target, which is like 60-something bucks a share. Is it? Yeah.
6-0?
In the short term, recently he has been quite right. Even he is really shocked at someone even suggesting Tesla stock could go back down to $60 per share.
60-something, yeah, 65,
well,
69.
Let's say it this way. The path is 60, passes through 145. I mean,
right.
You got 60, that's tomorrow's lunch.
But
That's
is that like another support
it's very hard to know.
Lower than 140? Or?
I mean, look, anything's possible. I think that's, here's what I found is that when, just from over years, decades of publishing notes and clients, when you have something that's so outsized, you lose the audience. And not to say that Dan's audience is different than mine, but when I put out a note, a hedge fund manager, a pension plan, a family, they're like, come on, you think it's going to triple from here? You think it's, and so I try to have price targets that typically are where the imagination can allow. But listen, right. The imagination, maybe it's 60.
He just exposed why you shouldn't really listen to hedge fund managers, price targets, and overall analysts, because they do not operate based on reality. They operate based on, oh, you like to see a higher price target? Okay, let's adjust the price target to a higher price. Oh, you would like to see a lower price target? Okay, we're going to adjust the price target to a lower price target, even though, let's say, we think, a stock could actually 7x. Yeah, we're not going to say that. We're just going to say maybe a double. If you think a company is going to go bankrupt, then we're not going to say that. We're just going to say the stock is going to drop from here on a little bit, because otherwise we would not be received very warmly. We would rather please people instead of actually outperform the market. Just to be clear, I don't think that's the case in every single case, but certainly, as he's saying, that's how he likes to operate, and I think there are many more people like that. Nothing too wrong in that approach, other than it's not really based on the truth and reality, but rather what your imagination is capable of, I guess. So if you have never seen a stock double very quickly or 10x relatively quickly, yeah, if that's not the norm, then that means it's not really possible, which is wrong. Full self-driving has never been solved before, and therefore it will never be solved. Yeah, that kind of thinking is not going to get you very far. No one has done electric vehicles, therefore electric vehicles are impossible. Oh, well, look at how that kind of thinking paid off.
So let me ask you something. When you talk about given what's happened, is that just purely what's happened to the stock price as opposed to margins or cost cutting on cars, anything like it's just purely
remember, this is
technicals of the stock?
Well, this sell-off, right, is the equal opposite of what happened over the preceding 2 years. So you have a stock that no one believes in, and analysts' price targets are below the stock, and the stock keeps going up and up and up, and analysts keep revising their price targets. And then, of course, the stock turns down, and now analysts are lowering and lowering their prices. It's just exactly the opposite of what happened. A great unknown that's now known, right? The highest multiples, and you know this as a manager, are always assigned before you actually start to put up earnings. Once you put up earnings, then we can do our DCF. The biggest multiples ever are always on biotech or technology stocks that have never made a profit because it's all a dream. Once you start to actually make the cars, produce the earnings, have real margins, the things you're talking about, then you can't have dreams anymore. You gotta get real.
Well, if we were to get real, there is a chance, a good possibility actually, that the earnings may be wiped out temporarily because Tesla may just keep decreasing the prices further. So with that logic, it is actually possible that the multiple is going to get a lot higher because the earnings are going to be a lot lower. I'm being, of course, a little bit silly here, but speaking of dreams, I think Tesla still has a lot of dreams to actually offer. Many of them, I believe, are going to come true. The Cybertruck is the one that's really the closest one. Then full self-driving, of course, many, I think, investors are not really confident in full self-driving anymore, and that works in our advantage if you are a long-term investor, because there's no valuation assigned to that business, making Tesla stock lower, which means they can accumulate more Tesla stock at a much lower price. Then we have the energy storage business. We have the Dojo business, which Elon Musk said on the last earnings call. That could be a multi-$100 billion opportunity. So perhaps, and Elon did say it's a long shot, so this may not happen, but there's a possibility that just the valuation from Dojo could eventually turn out to be the valuation that Tesla has currently. It's a long shot though, but looking at the next generation vehicle, I think that's not really a long shot. That is pretty much inevitable. The next generation vehicle is coming. It's going to be a lot cheaper and it's going to offer a lot more value. And I believe it is going to be a clear winner.
Jeff, I'm curious what your take is on the quarter, because there seems to be a real narrative change with this most recent earnings. They're basically saying, you know, we're willing to fiddle around with price to boost sales. We will do anything to price. We look at pricing every week. There are very few companies out there, particularly of big ticket items, that say we're going to look at pricing every single week and decide on that week what we're going to do with it.
Yeah, maybe I'm wrong, but I thought I read something today that they tweaked a couple of models a little bit higher today after the move lower. So it's kind of all over the place. So it's hard to project what the margin profile is going to look like. And I think that is maybe part of what investors are struggling with right now in terms of the stock.
That's right. The prices for the Model S and X in the US have been increased, although a lot of free supercharging has also been added, but I don't think that fully offsets the price increase. And I certainly won't be surprised if Tesla cuts prices again for many of its models. And this is an important message to all Tesla stock investors. My name is Matt. Post this, like, and subscribe if you haven't yet, and I will be buying more Tesla stock regularly. Thank you so much for watching.